Hello and welcome to our latest edition of Novelty. I'm Levon Baronian, your host, and today we have a special and very time-relevant episode lined up for you. As we all know, tax day, April 15th, looms on the horizon, and with it comes the annual flurry of stress and uncertainty surrounding our tax obligations. Here at Novelty, we understand the challenges that tax season can bring, and we're dedicated to providing you with the knowledge and insights you need to navigate it with confidence. In today's episode, we're diving headfirst into the intricate world of tax strategies, focusing specifically on how everyday people can leverage strategic planning to optimize their financial well-being. And joining me on the show will be Haig Nashalian, a distinguished tax preparer, tax accountant, and business advisor who has a wealth of experience and expertise in helping clients navigate the complexities of the tax landscape. Throughout our conversation, we'll explore a range of topics, from common tax deductions and credits to retirement planning strategies, investment considerations, and more. Our goal is to demystify the tax planning process and provide you with practical insights that'll get you thinking about your own financial situation. So let's get right to it. Haig, thank you for joining me on Novelty today.
Thank you for having me, Levon Baronian.
You're welcome. Thank you very much. So let's get right to it, Haig. This is an interesting topic, especially since tax day is right around the corner. A lot of people say that you shouldn't wait for the last week, right, before your taxes are due to start thinking about taxes. Tax planning is something that should happen throughout the year. Can you explain a little bit the importance of tax planning on individuals and families?
Sure. Basically, tax plan, you have to understand your tax bracket you're in. For example, if you're married, filing jointly, or married filing separately, or even single, you got to know what your bracket you're in. You could ask your tax advisor and to see whichever fits you the best. Learn how the tax credit and deduction works. That's very important. Get involved with your taxes. Don't let a preparer just say, sign the document, I'm done with it. Ask the questions, because that's your right to ask. And on each income tax return at the bottom, it says, under penalty of perjury, I declare that I've examined all the tax returns.
Sure.
So you got to have all the backup receipts and all that. And next one, it says, take advantage of your popular tax and credit deductions. They're all available. That's something, it's your right. You could ask your preparer to have that. And the next one is to keep good records. I got a lot of clients where they just don't keep good records, and in case if they get audited, it's tough to prove. Receipts is very important. And the next one is tweak your W-4. Go to your HR or to your boss and just tell them that I don't have 5 dependents. I'm married with 1 dependent. This way they take a little bit less from you, so you don't wind up owing end of the year. And last but least, leverage your tax advantage by having different venues, like for example, IRA or retirement account, or different options. For more details, we can discuss it at the phone number provided to our company. I'm with Brilliant Tax and Accounting Service, and we're a firm. We have a CPAs and EAs, and we have a bookkeeping, sales tax, bookkeeping, the whole department. It's a complete CPA firm.
All right. So in general, we hear a lot of people complaining about, so many different types of taxes, right, in this country. Obviously, we all know about income tax, but there are different types of income tax, right? There's different things that are being withheld from people who have payroll, paychecks, but there's also different income tax categories for even self-employed people. Can you talk about a little bit about the different types of taxes that we each pay, as citizens in the United States, and particularly as Californians and Los Angeles residents?
Sure. There's all types of taxes. For example, if you work for someone, they have to deduct payroll tax, which consists of whatever you put in on W-4 and DE-4, how many dependent, that's federal and state. Then you have a Social Security, you have Medicare, and you have SDI. These are all percentage basis, and it has a cap. Now, sales tax, we all know, if you buy a product, it depends where you live, they have to charge you sales tax based on that area. Even if you buy a car from a dealership, they have to see what your driver license is at. They have to charge you the rate that where you live.
Oh, really?
Of course,
So it's not where the business is located, it's rather where you live?
where you live.
So if I live in, let's say, Sherman Oaks, and I go to buy a car in
Simi Valley,
Simi Valley, which is a different city,
and it's much lower sales tax, they still have to
they still have to charge me.
for the Sherman Oaks.
Interesting. Okay.
Yes. Then you have a luxury tax. That's with the real estate. Then you have estimated taxes. Let's say you owe $1,000 or more for Fed or state. They make you pay at least $250 each time 4 times. So this way, that's called estimated taxes. So you have to really be control of your taxing issues. So to avoid penalty, interest, and all types of surcharges that you shouldn't have to.
Yeah. So unfortunately, there aren't probably any legal ways of getting out of paying sales tax. And if you owe a property, there's also very few things you could do to not pay a property tax, right? Or are there things you could do to not pay a property tax?
With the property tax, anytime you buy a property, you're assessed 1.25%. Okay, let's say you buy a property for $100,000, your property tax is $1,250, is due every year, January 1st, delinquent after April 10th, and the next one is due November 1st, delinquent after December 10th. Anytime you do additions, they could readjust it at the county assessor's office, which brings to mind that a lot of people, a lot of our nationality or different people, they do quit claim, thinking that I quit claim the property. They could reassess the property, because the only time they don't reassess it is between spousals, husband to wife, or husband to wife, or wife to husband. They took out the law that if it's siblings or parents, it doesn't matter.
So when you say you could do a quit claim, is that a tax avoidance strategy that people are doing that?
No,
for?
it's not. But it will increase your taxes.
If you do a quit claim, because it could get reassessed at today's market value.
Exactly.
As opposed to, was it Prop 13? I think that
Exactly.
sets a limit on how much property tax can increase
Correct.
annually.
Yes.
I've even heard of cases where people do additions and they intentionally don't get a certificate of occupancy to potentially not re-trigger a reassessment. Is that a smart thing, or
it's not a smart thing, because sooner or later they'll catch up with you. For example, I did addition in my house, and whatever I bought it for, that stays. But if I did addition of 500 square feet, they'll look at how much it's worth per square footage in that area, times how many square foot you additioned it, and you get a supplemental tax bill. Sure. Then it'll be normal tax bill, which is due every twice a year.
Okay. So let's talk about kind of everyday scenarios, because most people don't have fancy tax situations. Most people are either on a W-2 where they're employees and they get a paycheck, or they own a small business. So what are some common tax deductions and credits that people often overlook?
Sure.
Not the common ones that we all kind of know, like child tax credits and whatnot, but what are some of the things that are overlooked?
The way it works, that there's 3 types of income. There's a earned income, which is W-2. There's a passive income, which is rental property. And there's portfolio income, which you're making money on top of your money. A lot of people miss out the deductions that they're entitled to, which is you got the standard deduction and you got the itemized deduction. They miss out with student loan interest. I see that a lot from other accountants. I see that sometimes somebody wins a W-2G gambling. They forget to offset it with losses, because IRS says if you won, let's say $10,000 at Pachanga, you can write off $10,000 loss. It will not let you exceed that.
Because they're going to give you a 1099 for that, or G.
1099-G stands for gambling.
But what if you didn't track your losses? They won't include that on your 1099-G.
They will not. But you can call the casinos. They'll give you a win and loss statement.
That's if they're actually, like, if you're playing on a card or something.
Exactly.
So that's an important note for some of our viewers that like gambling. You never want to gamble and lose without tracking your losses, because if you win, you're going to pay taxes on it.
Definitely.
And if you're not tracking your losses, you can't offset that as part of the losses, so that you minimize your tax bill, right?
Definitely.
Interesting. So all you gamblers out there, make sure when you're losing money that you at least track your losses.
Exactly. So a lot of people think that because I went to an accountant, he got me a big refund, but it's not us. It's all regarding the numbers, whatever they deducted. If you have kids less than 23 years of age, and then you make below a certain amount of money, you're qualified for earned income credit. The government gives it to you, and there's a chart. If you have one child, they give you more. If it's up to 3 children, that's what it is. But it's all what you provide us, because we all use the same software. H&R Block, us, or CPA firm, it doesn't matter. It's the higher the risk, the better the return.
Sure.
But unfortunately, there's certain risks are not worth taking because sooner or later they'll find out about it.
So when you say risk, when somebody prepares your taxes, you're like, let's say, electronically submitting the tax returns. I think very few people probably send in paper returns nowadays. The IRS doesn't automatically look at every single tax return, right? They're assuming that whatever you put in there is correct, and then that's what an audit is whenever they decide to actually look at your tax returns, correct?
Right. It's a very good point. I'm glad that you brought it up. When we do electronic filing, the IRS, let's say you forgot to give us the 1095A, the covered California, the Obamacare, it will be rejected. It says that according to us, you forgot this. Let's say you put a dependent and your brother claimed your mom as a dependent. It would be rejected. It says, someone else got that return.
Oh, so those things are already inside the system.
Exactly.
So those types of mistakes are prevented from the get-go.
From get-go.
But the IRS doesn't know, for example, that if you claim you gave $25,000 to charity, right? They don't have a way of unnecessarily connecting that to the charities, or do they?
They'll do that. They'll cross-reference with the 501c 990 to see if that. But the law says that if you donate more than $500, they need to know who did you donate it to, because there's 2 types of donation. There's cash and non-cash. The cash, you need to put in, let's say, the church, Salvation. The Salvation Army is non-cash, clothing. IRS has a chart. It says certain items I have from start to lower, whatever it is, that's a quantity, 2 couches at this price. So it's better to have it right from the beginning. And usually when you donate Goodwill or Salvation Army, they don't fill it out. But we have a chart that you can fill it in, have the card of the manager, and have it signed. This way you have evidence.
I see. So you're not declaring yourself what the value of it
Exactly.
is. You have somebody else doing it, and that's more justifiable.
Or you can follow the IRS chart that they print out. It's much better. It's much safer that way.
I see. So for people that are on W-2s, I've heard that one of the best things that they could do is actually contribute to their 401k.
Yes.
A lot of young people kind of don't do that. Right. And it's probably one of the easiest ways that you can minimize your tax burden, and save money. Can you talk a little bit about that, about the 401k program, and why if you think every person should contribute the maximum to their 401k?
Yes. Every employer, especially big companies, they provide a retirement plan, so they can keep the good employees and all. Now, you cannot be discriminative. They have to offer to all the employees, even the officers of the company. Now, there's 2 types of IRA. There's one, it's called 401k, which is a regular IRA account, and there's one, it's called Roth. And the advantage and disadvantage of either one of them, the IRA, what happened is, let's say you make $100,000, and your employer contribute whatever you have to contribute. There's a limitation percentage, and let's say you put in $10,000. So you made $100,000, but you got taxed on the $90,000.
That
So
$10,000 goes
deferred.
into that retirement savings account, pre-tax, so you don't pay money on the money that you're putting into that. What are the limits on that nowadays?
There's a limit where you can put up to 7.5%, and the employer will match that. But if you do Roth IRA, okay, it's after tax, okay, but in, let's say, 25, 30 years from now, you want to pull out that accumulated income, you will not be taxed because you already paid taxes on it.
So the money was after-tax money that you put in there.
Right.
And even the accumulation of interest or whatever, even though it grew, you're not paying any tax on that.
Right. But you have to be careful of one thing, one major issue. Do not take it out before 59 and a half.
That's the threshold.
If so, they'll take the tax and they'll hit you with 10% penalty. And I have people that I tell them, don't take it out if you don't need it. Or if you have to, you can tell the 401k, I need a loan for up to 30 days or 60 days, you can put it back.
For up to what amount?
To part of it or all of it. If not, that will be taxable.
Interesting.
Yeah.
So a few years ago, I heard about this thing called a solo 401k, which is a type of 401k, I guess, for business owners.
Yes.
And effectively, the company that was telling me about it said that in that type of a 401k, you could even purchase property or even, let's say, gold bars. Is there such a thing?
Yes, there is.
Okay.
It's a very good question. So there's a company, it's called Clearinghouse. What they do is that, let's say you have accumulated $200,000 in 401k. Well, this company will take that $400,000 that you have in your portfolio. You left your job. You could open up a corporation or a business, and that will be just like investing it. But you cannot take it out. And then when you do take it out, you have to pay. You still have to pay taxes on the gain.
Sure.
But there is multiple companies that's all they do. That's their specialty. So you don't have to have it just there. You can even buy real estate with that money, but you cannot touch it. When you sell it, it will be the same thing as 1099-R. Let's say you take the money out, you get a form, it's called 1099-R, and it will have a code, rollover. Let's say you change your employer, or it'll have a code that early distribution, or so that kind of stuff.
So I think that's a key thing for people to keep in mind, because a lot of the reasoning I hear, at least from young people, on, well, if I put in my 401k, I'm not going to be able to do anything with that money until I'm 62 years old, right? So especially like when you're in your 20s, for example, it seems like a really long time away, right? You're like, well, I'm going to tie up that money and I can't do anything. I'd rather have that money and invest it. There's actually opportunities to invest that money in real estate and all that kind of stuff. You just have to structure it correctly.
That's
right?
correct.
So that's something I think that our viewers should keep in mind, that put that money in the 401k this year. Don't pay the taxes on it, right? Let that money accumulate tax, before you pay taxes on it, and then you can have options with it down the road.
But sometimes that your employer would not allow you to segregate your portfolio in the stock.
I see.
They have it. I've seen one too many clients that because the employer said you cannot choose, for example, high-tech, medical, or even crypto, because they're not allowed, and when the economy hit, they had their portfolio about 50,000 went down to 8,000. So if you're not sure of the stock, do not do it. Now there are some people where they invest their IRA in a principal guaranteed. That means I don't want to play with my earnings. It may go down because it's like anything else. It's like the New York Stock Exchange has that thing, but. If you're not sure about it, ask your employer, do I have the right? And then you'd be the judge of that. When you get the statement every month, work out with the Excel and see how's it growing? Is it losing money? Is it there? You have to be in control of it. The thing is, it says, don't trust anybody except yourself. That's more important.
Okay. So a lot of people took on these SBA loans over the last couple of years, especially during COVID. There are different types of loans that the government was giving. Are there any opportunities for forgiveness on some of these loans, and what qualifies somebody to get those loans forgiven?
That's a very good question. We had a client where he was delinquent for about 6 months. We called the SBA and they said you have to submit a form waiving those 6 months that they missed with the interest and penalty. They tack along with the end of the loan. That's one. Second one that we just had, I talked to the bankruptcy attorney, and they formed it where they can wipe off the loan under certain condition. Number one, it has to be a corporation that borrowed the money. Number two, it has to be less than 200,000. That's what I heard. Oh. But we're not law firm, obviously.
Sure.
But we can refer you with our local attorney who would explain more in details all the do's and don'ts and what are the requirements are. But I talked to him today regarding a client of mine, and he said, refer it to me. I'll explain more, but it has to be a corporation who borrowed the money, not individual. and also it has to be less than $200,000.
I see. And you raised a good point, Haig. We're not giving any legal advice here or even tax advice. We're basically just having a good discussion. You should always discuss with your tax accountant, tax preparer, attorney on what are specific to your types of situations. So, a lot of people now, because the economy's tough, they have side businesses, side hustles, as some people would like to call it. But even something like driving Uber or whatever. What are some things that are important to keep in mind for people that are like outside of their regular work, if they're trying to do some business on the side? What are some things that they should keep in mind, as it pertains to their tax situations?
Sure. So because we, beside doing taxes with Brilliant Tax and Accounting Services, Inc., I have a business called Nash Legal Document Processing. So the banks in this area, they keep sending me clients where they want us to form a DBA, doing business as, or a corporation or LLC. Now, be rest assured that you could have a side hustle. The IRS said that anytime you spend money to make money, as long as it's reasonable, and it has to be in connection to your trade or business, and it cannot be lavish. Now, let's say you did a side hustle, and the first year you had losses. The W-2 income you had, it will offset it. Okay, maybe the first year will be a little bit loss, the following will be lesser losses, and eventually you might wind up having, profitable as time to shift your job to do that. But it helps because anytime you make money, the IRS will allow you to write it off, but it has to be reasonable.
So are you suggesting that even people that necessarily aren't thinking about a side business should potentially look at it for tax implications? Because they could potentially, turn a hobby into a business and save some money from their taxes. Because if they're spending money on that hobby, but if now they can justify it and do it in a way where they are trying to make money from it,
right,
at least that money that they're spending could get deducted from their taxes.
Exactly. But the IRS is very strict. If they don't want to subsidize your hobby.
Sure.
It has to have, so in order to be legitimized, we get a DBA, we get a business license, you have a website, because right now technology is so strong you could do it yourself. It's just copy and paste type of thing. And then you're having potential clients, you have a business card, so they know it's not a really hobby. I turned down a couple of clients of mine that they wanted to jam with the music. I go, that's not a business. I'm so sorry, I would love to help you, but that's not a business.
You have to try to actually make money from it.
Exactly.
So if they were going out and trying to get clients to hire them to play, their
that's
music,
a different issue.
Yeah, at that point, then even if they weren't really that great musicians,
I mean,
there's no judgment on that, right? You might not be a great musician, but you're trying to have somebody to hire you.
You bought equipment, you had internet at home, and you did all this to generate income.
Sure.
And to generate income, you had to spend money to come up with the expenses.
Okay. I think we got a lot of stuff in today, but of course we could talk about this for hours. It's one of those topics where there's so many things to consider when you're planning for your taxes, when you're planning for your finances. But I want to thank you for coming out today, Haig. Is there any last bit of information that you'd like to share with our viewers?
Sure. I see this a lot where people bring the actual income W-2 and all that, and they forget to bring certain documents. And that's how we get a CP 2000 IRS letter. It says, according to whoever reported on you, it doesn't match with yours. So I urge you to open up an IRS account, go to YouTube, follow the steps that you can open up an account and find out your wage and income summary for that particular in question. For more details, please call our office. We'll be happy to give you a free consultation. We'll go over your taxes, even the prior year, in case if your prior accountant missed any deduction that you're entitled to legally and ethically.
Thank you, Haig. So as we wrap up today's episode, I hope you found our discussion on tax strategies insightful and informative. Remember, tax planning is not just a once-a-year task. It's an ongoing process that can have a significant impact on your financial future. By understanding the various strategies and opportunities available, you can make informed decisions that help you keep more of your hard-earned money in your pocket. I want to extend my heartfelt thanks again, once again, to our guest, Haig Nashalian, for sharing their expertise with us today.
Thank you.
I also want to thank the Alpha News Network for this platform. And until next time, stay curious, stay informed, and keep exploring the novelty of the world around you. Take care and thank you.